Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevenson, and today I'm going to be bringing you a story all about the fertiliser market and what's happening in South Australia. Leigh Creek Energy, ASX code is LCK. I'm talking with their executive chairman, Justyn Peters. And as you all know, especially right now in the news, what is it? All the supply chain disruptions, but you're going to find out why Leigh Creek Energy is going to be a very important part of our agricultural landscape going forward. So, Justyn Peters, thanks for joining me today on Small Caps.
Thank you, Kerry, and it's great to be here talking with you.
Well, before we get started, because some of our audience out there will go, oh, Leigh Creek Energy, what are they doing? Energy is on everybody's lips at the moment, but you're a little bit different. So give us a brief overview of Leigh Creek, who you are.
So Leigh Creek is an ASX listed company, obviously. We are based in South Australia up at Leigh Creek, so the name suggests. We've been here 5 years, and we chose South Australia very particularly as it had a whole range of boxes that were ticked for us and our needs. So infrastructure was already in place in South Australia. The fact that the South Australian government was trying to attract business to South Australia, and the regional areas needed it. That investment, the number of people moving into the area, and the building up and the growth in those areas meant that we moved to South Australia. So Leigh Creek is north of Port Augusta. Okay. It's up in the Flinders Ranges. It's an arid area, but a beautiful area, I might add. It has a lot of wonderful areas when you travel up north through South Australia. We are a fertiliser company, and that is that even though the name of the company is Leigh Creek Energy, we started out as an energy company and then looked at what we could do with that energy. And we determined that what was best for us was to be actually in the urea, the fertiliser market. So our process is we make the gas, that gas then gets converted to ammonia, and then that ammonia then gets converted to urea.
Okay, so hang on a second. So you make the gas.
Yep. So we don't have to find the gas.
Sorry to interrupt you. Have you got gas fields up there? Are you extracting the gas up there?
Yeah, so at Leigh Creek, we've got a certified PRMS of 2P at 1,153 petajoules of gas. It's a fairly large amount of gas we've got certified, and that was certified a couple of years ago. To give you some perspective of that, we would probably be the largest uncontracted gas owner on the east coast of Australia. A couple of years ago, BHP had 1,150 petajoules in 2P. And I was proud of the fact we had 3 more PJ than them. So it's a good number, but that gas is sufficient for us to make fertiliser at Leigh Creek for the next 30 years. And that was what was important. We had to have enough gas to fully feed a commercial project for 30 years. And that's what we have.
Question for you. You say you've got a lot of gas at the moment, which will feed your project for the next 30 years. Would you think about taking that gas and putting it into the market? Because you know what? There is an energy supply issue at the moment, especially on the eastern seaboard. Would you look at potentially pushing that out into the market to help fund the project further down the road?
No, because we don't have to. One of the issues we had to look at originally was one of the options we could do with our gas was put it into a pipeline and take it across to Warrnambool and then across to the east coast. And you look at the gas shortages they've had, which were predicted a long time ago, I might add. There's nothing surprising here at all. We had to look at what we could get for that gas if we just sold it across to the east coast. So, and the margins were pretty good. They weren't bad at all, but nowhere in comparison to us keeping that gas and actually using it ourselves. So where our benefit in this process is, rather than simply selling the gas as a base product to someone else to make money out of and to generate their funds, if we could afford to keep it ourselves and us make money out of that gas, is going to be the best return for our shareholders, right? So the issue then is, and it sort of leads in from that question you just asked, is, do you sell the gas to then raise the money to do your project? We don't need to do that. We, with our partners and that, we'll be able to raise the full 100% capex that's required for the project without selling our gas to anyone else.
And the gas, so does that help you? And look, I'm going to get into the detail, but before I do, we talked about gas price. I'm going to come back to that for a moment. But given we're talking fertiliser, for my audience out there, give us the macro picture at the moment. What is the, I guess, the supply and demand at the moment that is going to make this project pretty good. But let's big picture it for a second.
The fertilizer market is really interesting and it's changing quite rapidly. So if you have a look at urea, it's a nitrogen-based fertilizer.
Yep.
Right? It's a way of physically getting nitrogen into the soil. It's what the farmers need in barley and wheat. So how do you do that? You have urea. It's a solid pellet, and that's spread by farmers across their land when they've seeded, and that's used, puts the nitrogen in the soil and gets things growing. Your crops, looking at least 30 to 40% increase on your crop productivity if you're using this fertilizer. So it's very important for the farmers. Okay. The problem you have is that it comes from gas, right? So urea is made from gas. What happens is that at any urea manufacturer anywhere in the world will get gas. They will convert that gas to ammonia. They'll add CO2 to the ammonia and they'll make urea. That's just the process.
There we go.
It's just the process that's done. Now, of course, you have a problem. If your first part of that process is gas, then urea is always going to be, the cost of urea is always going to be linked to the gas price.
Gas, yep.
Okay, so what's happening in the gas around the world? If you look at the three locations, Europe's gas prices, Russia supplies Europe its gas. Gas prices there are sitting at historically high levels at the moment. They've never been as high. If you have a look at China, China produces and exports a huge amount of urea. Their gas prices doubled. But more importantly, China has now banned the export of urea, right? Because they want that product to stay in China so that the farmers there have their guaranteed supply of urea for their productivity. If you look at the US, the Henry Hub gas prices are at high levels now. And what that means is that anybody who has to buy their gas to make ammonia and urea has a huge input cost, right? And then the other part of the problem on the urea market at the moment is the infrastructure, and that's the logistics of getting urea around the world by ships. Everybody knows there's a shipping crisis out there at the moment, and it's very difficult to get your product onto a ship. Urea is no different. So if we're importing from the Middle East, then that urea has to come by ship, right? And the old lead time used to be about 12 weeks, and that's now out to 3 to 6 months. So unless you're ordering well in advance, there's going to be this actual problem of getting enough urea into Australia. And in Australia, we use approximately 2 million tonne around Australia a year. So it's a big business.
Where do we get the majority of it from the Middle East? Where does the majority of our supply come? Have we in the past got it from China? Where's our supply been coming from?
Well, we get it from a blended area. So, for instance, Incitec Pivot, IPL, they manufacture around about 300,000 tonne a year out of Gibson Island, Queensland. So there's about a 15% component coming out of Queensland, and then the balance comes from China and from the Middle East. That slack has taken up because China's not exporting. It's coming out of the Middle East, and what are we seeing? 12 months to 18 months ago, urea prices in Australia were approximately $400 a tonne. Right now, they're over $1,400 a tonne. So
and that's due to the cost of the gas. Those, as you said before, those input prices going up, the price has to go up.
And China not exporting. So you've got this less product coming out internationally for export. You've got gas prices moving up, so the input costs have gone up. And then you've got the logistics of actually transporting things around that are harder and more expensive. It's much more expensive now in shipping. So you add that all together, anything that's imported in Australia has to cost more. That's all there is to it. Right.
So if you've got your own gas, which is really interesting, you've got, as you said before, enough to make urea from this project for the next 30 years, you don't have to rely on third-party supplier, I guess, as a result. So talk to me about that cost saving and how that's going to impact this as a low-cost producer.
I think this is probably one area, if not the area, where we have an advantage over anyone else, both in Australia and internationally, and that is this. If you look at roughly, depending on the sort of plants you use, if you looked at 30 gigajoules of gas being used per tonne of urea, it varies depending on the process you use and how old your plant is. But if I use that as a number and an example, and if you're paying $10 a gigajoule, now I can tell you that in Europe at the moment, they're paying well over $19 a gig. But if you're paying $10 a gigajoule, just to make it easy for the numbers, is that if you're using 30 gigs and you're paying $10, the cost of your gas as a manufacturer to make ammonia and urea is $300 a tonne. For us, our gas price is around about $1.20 per gigajoule. right? So it's an order of magnitude different.
What's
You say that, okay, so we look at the 30, let's look at the 30 gigs again, and let's say $1, make it easy.
Yep.
Our input cost is $30 a tonne. Anyone who has to buy gas at $10 a gig, their input costs are going to be $300. Now, there are people that are saying they think they can get gas from different locations at between $4 and $6. But even at $4 a gigajoule, that's still 4 times more expensive. Our input will be $30 a tonne. Theirs will be $120 a tonne. And that's our major advantage over anyone else out there. So when we first looked at it, it gives you that the importance of it about your fixed cost for the next 30 years is that's our gas. We don't have to buy that. So there's no CPI increases. There's no sitting down every 5 years renegotiating with the supplier. There's no risk that's going to, if anyone thinks it's going to be where it is today in 30 years' time, they're
laughing.
They're dreaming.
Tell them they're dreaming.
Well, they are. Tell them they're dreaming. But for us, the only difference between that $1.20 price today and in 30 years' time will be the cost of labour will have gone up in that time, but labour is not a huge part of the cost in that gas. Electricity prices will have gone up, but we'll be producing our own electricity anyway.
You're producing your own electricity as well?
We're having our own power station at site.
Okay.
So we'll have our own electricity, we'll have our own gas. So the only variable that sits in there will be labour costs, which won't be huge, but they'll still be an increase in cost. So for us, it's possible that in 30 years' time, we might be sitting at $2 a gigajoule, but our competitors won't be sitting at 10, they'll be sitting at 20 and 30. And that doesn't go away over the life of the project.
Well, that is very interesting. I also want to find out about the sort of the CO2 emissions, because we are going into a world where everybody's talking about carbon footprints and the like. And you talked about your energies, your electricity is going to come from renewables. Is that correct?
Yep. No, we're going to be making it from that gas as well. So we'll actually make our own electricity from our own gas.
Okay.
We can use renewables, by the way. I mean, we're actually looking at part of that, or as much of that as possible, either in solar or wind. More solar likely in that location, I might add. Yeah. But I think what we do with the CO2 is much more important.
Justyn, where are you at? Give our listeners a picture of where you're at the moment. Leigh Creek Energy started in 2015. We're coming into 2022. Where's the value proposition going forward for shareholders or those that are looking at Leigh Creek Energy right now?
Look, I think it's interesting, Kerry, in that you start out in 2015, you have all these things sitting in front of you got to do, and you hope that each time you actually deliver on one of these important milestones, that the market gets to see that, the market gets to understand the story better, and from a value point of view, the market recognises the value of the company in the future it's going in.
Yeah.
It's difficult. It is difficult for a lot of people to sit there and invest in something that they sit there and see that it's going to be 3 or 5 years before you get revenue. Right, so they hope for the blue sky and that share price, that between when you start and when you get to revenue, that you're going to get that growth in there, and they're going to share in that growth in the share price. Let me give you an example of some of the things we've achieved in the last 12 months that are incredibly important to the project. The South Australian government granted us a petroleum production licence. That was the last licence we needed to produce gas from the South Australian government on our tenement at Leigh Creek. We signed, we've had a lot of work done on CCS. We've been to the conference that was in Glasgow just recently. We were invited to that conference because we have a proposition that in the urea market that is very unusual, and that we believe will be zero carbon, but I'll explain why that will be the case. We signed a EPCC contract with Dalium back in, I think it was September, we signed the actual contract.
Just explain, sorry to interrupt you again, just explain Dalium and who they are. Okay,
so Dalium are an EPC company, but for a lot of people who don't know what EPCC is, it's the actual engineering of the plant. So they actually do the engineering work to build the plant. Then it's procurement of the equipment for that. So procurement of your gasifiers or of your CO2 strippers or whatever as part of the ammonia urea plant. That's the procurement phase. The construction phase is the C, so they construct it for us. We don't have the skill set to build an ammonia urea plant, they do. And then you have the commissioning component. So there was the EPCC. We had an unusual one, and we had an F on the end of it because we had a funding component in there that whoever we went out with was going to have to come to us with a funding proposal for a large part of the project. Dalium are one of the largest EPC companies in the world. They're based in Korea. They have, if you look at their website, and in fact, if you look at some of our announcements to do with Dalium, we show where their projects are. They're doing huge projects in the Middle East. Aramco, they've done major projects with other fertilizer companies around the world. So Dalium was extremely important for us. One of the things that was important with Dalium signing up with us was the fact that a company their size would not normally do business with a company our size.
Yeah.
EPC contract, $2 billion contracts are big contracts. They need to be comfortable that we can do what we say we're going to do, that our process works. They're very environmentally conscious, and so there were environmental issues that they had to be satisfied with. And then, were we going to be suitable working partners? So when we say we're really proud to have Dalium, a lot of people think that, you sign an EPC company, who cares, but you're going to pay them anyway, so of course they're going to sign. That's not true. That is not true, and particularly when you look at the funding component of the package. So one of the major Korean banks has provided us in writing a support letter stating that subject to a satisfactory bank feasibility study, which we're working with Dalium at the moment, we expect to have finished in the very near future. And I mean, we've got to go to final investment decision before September this year. So the bank feasibility study has to be finished well in advance of that.
Yeah.
So we're working with them on the BFS. Now, the funding component for that 70% is based on the fact that there's a satisfactory BFS, bank feasibility study, that comes through, and subject to us negotiating proper commercial terms with the bank. But that's a 70% part of the funding. Now, we're comfortable and we're confident that the BFS will do both, show that the business is financially viable and sound, and that secondly, that will allow us to secure that 70%. So then from a company, we simply have to secure that final 30%, fund the whole project.
Where's the 30% going to come from?
There's about 5 different ways you can do it. Okay, so the first is in the obvious way, and it's the old mining model. Go out and get a binding offtake agreement with a reputable third party. So you have someone who's going to guarantee they buy your copper, or they buy your iron ore, they buy your electricity, or they buy your urea, right? And it has to be a reputable party that's bankable. So what happens is you'll sign that offtake agreement with that party that guarantees if you produce this urea, we will buy it off. You will buy 500,000 tonne. And we're working through that with Dalium. Dalium have actually signed a heads of agreement with us to actually buy up to 600,000 tonne of urea a year.
Okay.
Right. Because Korea has a shortage of urea, just like everybody else has. So that's one way you can fund that 30%, is buy an offtake agreement that's binding, that's bankable. You can do it that way. Another way is you can take in a strategic partner who buys 30% of the project. So if they buy 30% of the project, not 30% of Leigh Creek, they buy 30% of the project, then you've just funded your 30%.
So you've got some options there. So you're not necessarily going to go back to the market and do a cap raise and dilute shareholders by the sound of it.
Certainly not for the $2 billion, we're not. But on that 30% gap, that might require, you could do a debt equity facility there. So you could do a component of debt and a component of equity in there. So we're still going to have to go to the market to cap raise over the next couple of years.
Okay.
Right? We're not going to be funding $2 billion out of equity raisings.
No.
You can't do that. Sorry,
not going to happen.
You cannot do that.
Yeah.
And you're going to be, you're going to end up with 5 billion or 6 billion shares sitting out there. And I don't like consolidations, but that's not the way we're going to fund this project.
Good to that is actually good to hear. We're running out of time, so I really want to find out just quickly. You talked about a bank feasibility study. You've talked about a final investment decision. Are those the big ticket, you know what I mean, big items for 2022? What else is on the cards?
Look, I think another offtake agreement as well will be another important one. I think announcing the funding packages so that once the BFS is done, then the offtake agreements are finalised, then the funding package for that 30% and the 70% is secured and FID is secured. I think they are the important things over the next 12 months. We announced last Monday that we were looking at doing due diligence on a project in Chile.
I saw that, yeah.
I think that'll move forward. That's actually quite an exciting one.
Why? And I said we're running out of time, but I really want to pick up on this. Why have you taken the focus away from South Australia, and done this deal with Chile? What's that all about?
Look, this is a balancing act, Right, and that is that, when you get a really good opportunity put in front of you, you just don't say no to it if it's good enough. Okay, that's the first thing. Okay, the problem with that, and we all know the problem with that, is that the market looks at it in two ways. They sit back and say, oh, you can't be confident with your own project if you're looking at another one. Right, there's your first criticism you'll get when you go down this path. It's a load of rubbish. All the guys in our office and all the girls in our office in Adelaide are all working on the Leigh Creek project. They're not working on the Chile project. Anything to do with Chile will actually be employing people to do that. We will not be diverting people from this one into that. Secondly, this is a really exciting project. And the reason it's an exciting project is almost all the work we've had to do over the last 3 years at Leigh Creek has already been done at this site. So the actual monitoring wells have already put in. The licensing process from the government of Chile has already been put in. The actual coal and gas is actually there on the site in land we will own if we go down it. So we won't be mining, we won't be producing gas on someone else's land. We'll be doing it on our own land. So it has a whole range of advantages, but I just have to coming back to it's a balancing act. This one has the opportunity because all the approvals are in place for us to get some revenue very quickly on this, as opposed to the bigger project at Leigh Creek, which will take a few years before we're into production and into revenue.
Do you know what, Justyn? I'm going to get you back, and we're going to do a shorter one because there's so much to unpack here. Let's come back in a few weeks' time and just focus on that Chilean project and unpack that for your shareholders and listeners as well. As I say, we're running out of time. There's a lot that you're doing at the moment, but as we come to the end here, give me 3 reasons why our audience should be sitting up and taking notice of Leigh Creek Energy right now, because it's an interesting time, but I wonder if the market fully understands and is cognizant of really some of the issues that, or some of the opportunities that are going to come in 2022.
Well, I think 3 reasons. If I went for the first, is that we're a local producer. That is that we manufacture urea in South Australia. We'll manufacture it, and it can be used both in South Australia and on the east coast of Australia. And that's a unique opportunity for us, that we're actually going to be a local producer and we don't have to rely on imports. I think the second reason is we've already discussed that, and that's the input prices on gas. We have a fixed price. We're going to be staying at that fixed price. Our competitors are always going to be dealing with an increased price, and that is something that will not change over the life of the project, which means we simply become more profitable as we go down that path and over those years. And then I think the third one is that because of that gas price, our production costs for urea are right at the bottom, certainly if not the cheapest in the world, certainly in the bottom 3 that we'd be sitting there. So we're in that safe quartile where competitors are going to struggle against us. And if they're coming in from overseas, they're going to have to pay for freight to get it here, and they still got to pay for their gas prices. So they are the 3 reasons I think we sit above anyone else.
Justyn Peters, has been an absolute delight chatting to you today. I hope our audience understands that Leigh Creek Energy really is on the cusp. It is unique. They have their own supply of gas, which makes them a very low-cost producer. They're there in South Australia, local producer, which is fantastic. And as Justyn said earlier in the interview, the cost of urea has gone from 3 years ago, about $400 a tonne, to today, what is it, about $1,200 a tonne?
$1,400.
$1,400 and rising, ladies and gentlemen. So very interesting dynamics here with Leigh Creek Energy. As I said at the start, the ASX code is LCK. Check them out. And we will talk to you again about that Chilean project in the next few weeks. Thanks for joining me on Small Caps.
Lovely talking to you, and I look forward to talking to you soon.